Awesome, everybody. Welcome for joining us. This is the California Cannabis Industry Association's educational webinar. For those of you familiar with CCIA, we do quite a few webinars per year, and this is actually the second or third year in a row we've done a tax webinar. So I think we can officially call this a series. So with us, we have Jessica Velasquez and Ruth Rose. We're the founding partner and tax partner of Indiva Advisors, who we've worked closely with for a few years, here to talk about what you guys need to know now about cannabis taxes. So I'll go ahead and let them start it off, and thank everybody for joining us.
Yeah, thanks so much, Justin and CCIA for having us again. And now let's call it a series. In our annual tax update series, we presented this same session last year, right at the turn of what we know now is the COVID pandemic. And so this time last year, there was a lot of different changes happening around stimulus packages and relief. We find ourselves here a year later, kind of in that same boat. We certainly are here to talk about cannabis taxes and we need to know, but timing is perfect in that we have some new legislation that was signed into law today by President Biden, and all the hard work that's been going on in the administration to get us here. But again, happy to be here. And joining me today on this series is my partner, Ruth Rose. So excited to share this with her and bounce back and forth as we go through our deck. So again, today we're going to cover what you need to know about cannabis taxes. And if we can go through the agenda, we're definitely going to cover some of the filing season updates, make sure everyone's aware of deadlines and expectations for what you should have in your queue over the next few weeks coming up. As I just mentioned, we had some significant legislation get signed into law today, so I'm going to cover some of the main highlights there and bullet points there. But then we're going to get into some of the nitty gritty, and again, the real substance of this webinar today, which is things that you need to know if you're in the cannabis industry. So we'll touch on cost accounting. We're certainly going to hit 280E again. We'll talk about cost of goods sold and questions that we get there from our clients and issues that we work with them on. And we're also going to talk pretty extensively around 471C. And so that's one of the hot topics, areas in our industry right now. And so we're certainly going to cover that. And at the end, save some time for Q&A and hopefully answer any questions you all might have. So let's get going. Excellent. So 2021 season filing updates. So as of today, as of the this webinar here, we've not received or have officially heard of any extensions to the current due dates. So for S corporations, partnerships, those returns will still be due March 15th, which is this coming Monday. And individual returns, C corporations, estate returns, trust returns, and a few others that are due on April 15th. Again, those are still due on that date. As of today, we've not received any official word from Treasury that these will be extended. So please keep this in mind. These dates are coming up right around the corner. So something we wanted to certainly bring to your attention can be extended. So keep that in mind as well. And extend automatically gives additional 6 months to file the returns. So S corporations and partnerships with an extension would be due September 15th. And the others, mainly individuals and C corps, and the others that I mentioned would be due October 15th. So again, those extensions can still be filed. But please remember that payment deadlines also remain the same, and those cannot be extended. So if you have a payment due with your individual 1040 or with your C corporation, please keep that in mind, that those payments as of today will still be due on 4/15 with no penalties and interest assessed to you all. With all of the changes last year, it was quite an interesting season for us as practitioners, and certainly for our clients as the taxpayers. There was many processing challenges. There was many changes to forms. The IRS was also, because of the pandemic and COVID, their service lines and service departments were also closed for several months throughout last year. And so because of that, they're experiencing an extreme backlog of all of paperwork that was mailed and needs to be processed manually. Their power of attorney forms are also backlogged. If you filed a change in accounting method where that was a paper file, that's likely still in process. So, our point here really is patience is a virtue. Please be patient. The IRS is certainly back in bringing those services slowly back and trying to get caught up with this extreme backlog that they have. But again, just something to keep in mind as you're working through this current year, working with your own advisors on these items, that there is a backlog there, and again, just something to be aware of. As we noted here, millions of 2019 returns still haven't been processed because of it. So wherever possible, we certainly suggest that you're doing an electronic filing of any potential form. If there's a fax number or something of that nature, please use those electronic means versus sending something via mail. Hopefully it'll get processed a lot sooner and a lot quicker. Ruth, did you want to add anything to this?
No, I don't think so. Just reiterating again that 4/15 payment deadline. You'll want to consult with your advisors to determine the amount of any payments that might be necessary, because that would be based on your 2020 income. So if you don't have a return being filed, you might have to do a little bit of estimating to determine what those payment amounts should be. And I guess also on that same note, don't forget your first quarter estimated tax payments for 2021.
Yeah, great point, Ruth. Those would also be due on 4/15. So things to note. As I mentioned, the president just signed into law this next stimulus package. Hopefully everyone's kind of seen it in the news. It's definitely something that is relevant. And with that, one second. So the American Rescue Plan is what it's called, was signed into law today. And some of the main benefits that we'll be seeing through this new stimulus package is, first and foremost, $1,400 per person in direct payments. So if you're a household of four, multiply that by 4. And that's what you'll be receiving in the next few weeks here. But some of the other key items that we're also going to see is extended unemployment benefits. So, an additional $300 is what that unemployment benefit is going to garner us. And so something to be aware of as well. This new stimulus package also kind of provided a benefit for last year, for 2020. So if you received unemployment income last year, or those spouses or others in your household received unemployment benefits last year, up to $10,200 of those unemployment benefits will be non-taxable for 2020. So that's a really big benefit coming out of this, again, in light of the pandemic last year, having several folks, out of work. So, and then again, one of the major provisions as well is large funds available through PPP programs for specifically in this go round, small and self-employed folks. So this is really great news. They're making the process a lot easier, a lot faster. The amount of which PPP would be funded on, particularly for those that are self-employed, is based on your gross amount received of your 2019 and 2020 income tax returns that you may have filed on Schedule C. So again, we're providing this information just in general with all of the news around the new stimulus package. We at least wanted to get some of those highlights back to you all. So as you're working through that with your household members or others on your individual tax returns, things that you definitely want to be aware of. Ruth, was there things that you wanted to add here?
No, I don't think so. Did we touch on forgiveness? That would be the thing to be thinking about as well for any PPP loans that you may have taken out last year. Make sure to go back to your lender and apply for forgiveness of those loans to the extent that they were used for approved expenditures. The forgiveness will not be taxable to you, which is great news. And even equally great, I guess, is the fact that the expenses paid for with those funds are deductible. So it's kind of a dual benefit, really, a three-way benefit in a sense, because obviously it also helped with cash flow. So
yeah, great points, Ruth.
Really good news around all that.
We typically get a lot of questions around, does my business qualify for PPP, right, Ruth? In the sense of, I'm a cannabis company, and do I even qualify for these stimulus funds available? And so definitely an area to talk openly with lenders because cannabis is federally illegal. The answer really is no, unfortunately. In that, no, we don't directly qualify for these funds if you're plant touching specifically. But there certainly is opportunity for those in the hemp space that is 100% legal because of the Farm Bill that was passed in 2018, as well as other ancillary companies that again are not plant touching and work or support the industry. So just some things to be aware of here.
Definitely. Okay.
Yeah, so we're jumping now right into our section. If you're a cannabis or hemp operator for that matter, these next few slides will certainly be relevant. And so Ruth, talk to us about Code Section 280E and start us off here.
Absolutely. Hopefully we won't put you to sleep. This is where we accountants get very excited because this is the fun stuff that we get to do on your behalf. Code Section 280E, let's start with that. Most of you are probably familiar, but there are two kind of key terms that govern how that has to be implemented. And so just to look at the language, it disallows expense deductions to businesses that traffic in Schedule I substances. So what does it mean to traffic? The direct sellers of product, that's an obvious trafficking activity. But what we've also found is that the Internal Revenue Code, regulations, audit experience, everything in our space tells us that if a related business or even an ancillary unrelated business, if the revenues are dependent upon the sale of the product, that's still considered trafficking. So that's something to be cautious of in carving out separate entities for, say, management activities or real estate holding, things like that. It's where you really need to get some good, smart advice around how you structure your business to make sure you're not, it's easy to compound the 280E problem with bad entity structuring. So it's just something to be careful of and get some really good advice around. So trafficking, it's really the source of the revenues. And then expense deductions. Any expenditure will fall into one of two categories. It's either cost of goods sold or it's a disallowed expense. And that's where the cost accounting becomes really, really important. So cost of goods sold is going to be any expenditure, whether you're purchasing your product, growing your product, producing your product. You might have recipes with ingredients. Anything that goes into the product you're selling clearly is cost of goods sold. There are additional, I hesitate to call them expenses. There are additional expenditures that can be included in cost of goods sold when they're directly related. So cost of equipment, for example, labor. Let's see. I'm actually going to skip to the next slide because we have them laid out. And facilities obviously is a big one. So whether you're renting space, if you own the space and you're taking depreciation deductions, all of those things that you couldn't create your product without those expenditures, those are your costs of goods sold. Things that are not allowed, by definition in the statutes, not allowed, are selling, marketing, and advertising costs. So the cost of retail space, the salaries paid to employees who are supporting that retail operation, administrative and office expenses. Security, we found, that's one that we've learned through extensive audit experience, is disallowed every time. So there are some that are clearly in and some that are clearly out. And then there are some that fall into more of a gray area. And those are the ones we look at we take a closer look to determine if there's some portion. It might be a small portion, it might be most of it, that would be allowed. And it depends really on the facts and circumstances of the individual business entity, how the operations are structured. So a building, you might have, we have clients that have indoor grow, a production facility, and maybe even a retail space all under the same roof. We'll look at that floor plan and determine how much of that space is allowable for cost of goods sold, and then look at the related costs and do those allocations to make sure that as little as possible falls out into that non-deductible bucket. Payroll expenses, again, we have to look at job descriptions. It comes down to a lot of detailed analysis to look at it on a person by person basis. What is the person doing for their job? Is it part of cost of goods sold? And again, do those allocations of all of the related costs. So the payroll costs, the taxes, the payroll service fees, benefits, everything related to those payroll costs. And then a lot of times there's an other category there. Again, every business is different, and you might have things on your chart of accounts that should be looked at. And so once again, our objective in doing this analysis is to make sure that as little as possible falls into that non-deductible category. And we do, I admit, have fun doing that. It's nice getting those wins for our clients.
Absolutely.
Yeah.
You know, if I could also some commentary around the allocation. You know, we get clients that do come and you know, where they have folks that, you know, have multiple roles within the organization. They wear many hats. They're admin, they're also working possibly in the production cycle, possibly they're doing inventory purchasing, and then some combination of a variety of roles. And so these details. These are about all of the applicable costs that we can attribute to cost of goods sold, to creating the product. And I know some of the clients often wonder, well, why are they asking me all of this? You know, why do I have to keep time records, Ruth? Why is that important in the conversation that we're having in this allocation methodology? If you'd like to talk about the importance of that.
Certainly, and thank you, because there was another aspect of this that I intended to touch on. You just reminded me, is your books and records. So it's not enough for us to just do the analysis for you. Any adjustments need to be actually incorporated into your accounting records for the entity, because on audit, the IRS would be looking at your books and records, not at our work papers. So that's an important distinction. But along those lines, they will look at what did you base those allocations on? And it can't be, well, if it was based on an estimation, oh, I think I spent about 20% of my time doing this and 30% over there, that won't hold up. But a good set of job descriptions, time records, and actual calculations that support the amounts claimed as cost of goods sold deductions, that's what will survive an audit. And that's always the goal, is to make sure we maximize the deductible portion of the expenses, but also that those deductions will survive on audit. To touch on that just very briefly, we've not seen an extensive amount of audit activity in this space, but a number of publications that have come out in the last, say, 6 months have indicated that the IRS has every intention of upping their focus on this industry. And so we want our clients to be prepared. But it truly is, it's that books and records, everything needs to be very well supported, documented, and recorded in the entity's accounting system in order to be in the strongest position.
Maybe to kind of stay on this topic and talk more about books and records, Ruth. You know, we certainly have clients that, you know, may not have a bank account and are still running their operations mainly on cash. And they come to us, you know, typically at the end of the year. That's, you know, someone needs a tax return filed. And in some cases, they won't have support for those costs or payments that they've made. You know, the receipt went missing. You know, someone didn't log it, etc. What happens there, Ruth?
Sure.
When you know the client or there's no support there?
Yeah. So we certainly don't want anyone paying more tax than they should. In a situation like that, we'll work with that client to develop the best possible records that we can. What do you have access to? What do you have record of? And we'll help to assemble the best accounting records that we can. We do a lot of this. But then step two in that, going hand in hand with that effort, is to establish some good accounting practices on a going forward basis. So we'll teach our clients how to maintain a cash log, to do weekly cash counts, to do maybe monthly or quarterly inventory counts even, to keep receipts and records of all expenditures, sales records, and to marry data together as best as possible, whether it's from metric over to a point of sale system, whatever the systems that are existing in place can capture, make the best use of those, and help to establish, again, if there's no bank account, if there's no accounting system in place, there still are things that can be done to piece it together, then to create something, at least something simple to capture activity on a going forward basis.
And yeah, absolutely, Ruth. And you kind of hit the nail on the head. What we try to tell, and really implore our clients is keep the receipts. Let's keep the support. Just for reference, the burden of proof in an audit is on the taxpayer. So if we cannot substantiate an expense, it's almost like it never happened. And those are immediately, thrown out of a, a category for the IRS. It's just not going to be an allowed deduction if we can't support it, particularly for cannabis operators. Again, we have some experience in IRS audits, and these are the key things that they're looking for: contemporaneous support, contemporaneous documentation of any allocations. They want to understand why we're doing what we're doing. That literally is more than half the battle in an audit. So really, the books and records just so important. And from our perspective, all of this is really accounting records into some sort of accounting system before we can even talk about getting a tax return done. Those are the key things we're looking for on in our world.
And in those situations too, we'll also advise our clients that a tax return that's based on those pieced together financial records will have a lot more audit risk in it than a return, say a subsequent year return that's based on good accounting records. So it's not that we won't file, but we may need to include a disclosure indicating that, it was based on the best available information. And that's not a bad thing. It's just everybody owning up to the fact that we're doing the best we can here. And then, when you can show that the subsequent year was based on better, more substantial records, then that certainly helps the whole situation.
Absolutely. Well, what else is going on in cannabis accounting, Ruth? What else are we going to talk about here?
Let's talk about Section 471C. Do you want to start?
Absolutely. So Code Section 471C is, although it's sort of the hot topic or the buzz in the industry over the last 18 months or so, really this law was enacted back in 2018 with the Tax Cuts and Jobs Act that was enacted January 1st of 2018. So created a lot of buzz, certainly in the industry. We've had a lot more discussion in this arena. There was also a TIGDA report that was issued last year on this subject matter, giving some additional clarity as to what it was and what it wasn't. But recently, we were issued some final regulations that gave us some more clarity as to, again, what it is and what it isn't. So Ruth, give us some more background on this.
Absolutely. So the code, you guys probably don't spend your time reading code sections the way we do, but the code sections tend to be little, like half a paragraph of text. And until they put out regulations or other documents that really explain how that half paragraph will be implemented, we're left to speculate and look at news reports and committee reports and things like that to say, okay, now where are they going with this? And so there were a lot of different opinions floating around that 471C actually opened the door to taking those non-deductible expenses we just talked about and pulling them into cost of goods sold. There was a group, one line of thinking, I'll say, that thought maybe that's what was coming, that the language permitted that kind of capturing of all costs into cost of goods sold. Others interpreted things a little differently, didn't quite see that. What it came down to is that 471C, it simplifies the keeping of inventories by small businesses. It doesn't change the deductibility of any expenses, doesn't change what we're allowed to allocate into cost of goods sold. But what it does do is it allows us to use a simplified method for determining what ending inventory is. And so there are certain hoops you have to, well, not hoops, they're not hard to jump through, but there are certain criteria. If you, if it's a small business, but for one reason or another, you're required, say by a bank, to produce GAAP-based, generally accepted accounting principle-based financial statements, then in that case, you do have to follow generally accepted accounting principles, which is what most people are following anyway. So you wouldn't be able to opt out of that if you have a bank requirement or an SEC requirement or some other regulatory body requiring you to produce GAAP-based financials. If you don't have such a requirement and you are under $26 million in annual revenue, then you can say, you know what, I'm going to use my own method. And rather than allocating all these extra costs into my inventory, and we had a case last year where GAAP calculations would have put their ending inventory at about $800,000. Using their own methodology, looking purely at the cost of the product on a readily available, I think it was their excise tax report valuation, put their ending inventory at about $150,000. And so that swung last year's tax return for that client by $650,000. Now, again, there are hoops to jump through. You can't just change it without telling the IRS what you're doing. So there's a few extra forms that have to be filed. There's some analysis and calculations that have to go into it to fully comply with the change in accounting method, but it can be very worthwhile. And so there's that kind of one-time adjustment that can be really beneficial, but it also can simplify the process of valuing inventory in your financial statements going forward.
Absolutely. Ruth, you touched on quite a bit there. So I'm going to come back at you here with a few questions to kind of further break this down. So you talked about GAAP financials or in GAAP reporting. Tell us more about that. What does that mean specifically for the client and someone that might want to do this or have some more questions?
Certainly. So generally accepted accounting principles are principles that are governed by the accounting bodies in the United States. And it's what lays out general accounting concepts and approaches. And it's what permits us to do the allocations, to capture certain costs in cost of goods sold and to allocate costs between cost of goods sold and other expense accounts. So that's why I say most people are following GAAP, whether you know it or not. It's our kind of generic accounting methods here in the United States. The 471C methodology allows us to simplify that when it comes to inventories. And so the 471C method is not necessarily a GAAP method, but it's permitted for I was about to say for tax purposes. Your tax return has to match your books and records. So if you're going to file your tax return using this, you also need to use this method for your accounting records that you would use internally for management purposes, for banking purposes, for any reason.
And that's a great thing to call out there, Ruth. So thanks so much for that, because we did get a lot of questions last year from several clients and prospects and just everyone wanting to know, like, how do I fully load up my ending inventory and get to deduct everything for cost of goods sold? I heard 471 is my saving grace here. And so to your point, Ruth, we have to have an understanding of the client's business. What is your operation? We alluded to earlier, not every business is the same. And that cannot be any more truthful based on the variety of calls that we fielded last year on this subject matter. So it is important to understand gap reporting and whether or not your company or business may be required to do that for one reason or another. In the case that Ruth mentioned, I know she said banking, but what we probably see more prevalent in our case is agreements, management agreements, investor agreements. You know, most of the language in those agreements call for gap accounting or gap reporting, because that is the, as Ruth pointed out, the language that we all speak in accounting. And so if those agreements, you know, tie the financials to gap reporting, this may not be a viable solution for you or option for you. So all of those things, really understanding the client, the business, where you're at today, what's going to happen tomorrow, and next year, having some foresight into the future also is relevant when determining if this is the right, you know, pathway for you all. And so a lot of questions kind of coming out of this, Ruth, for sure. So tell us why we can't just drop, besides what I just mentioned, but tell me why a new operator should not or should just go right into 471C. Tell us more on that.
Actually, this is an exciting opportunity for new operators, because 471C would allow that new operator to adopt a simple method of valuing inventory right from the start and doesn't have to ask permission to change its accounting method. Whereas an ongoing operator that has an established method process of accounting for really any item in its tax return and in its books and records, if that methodology is being changed, we need to notify the IRS of that change. And some changes fall under automatic approval procedures, and others don't. So it's that new operator has a great opportunity to establish their chart of accounts, their accounting methods, in a way that makes the most sense for the business. And 471C, I would advocate most of the time, makes sense to adopt this simplified accounting or valuation method for a new operator. Again, it can make a lot of sense for existing operators. We just need to step back and look at the real kind of a cost benefit of making the change to see, does the cost of making the change outweigh or you know, substantiate, justify the long-term benefit of simplifying some of those procedures.
Absolutely. So Ruth, if a client or, you know, a cannabis operator wanted to change their method of accounting for ending inventory using this section 471C, what would you say is kind of the key things to go down that pathway?
I would, a bit of analysis, again, we always like that, but looking at how much indirect cost burden they're carrying in their ending inventory and how much work it takes to determine what that burden is. Because it may be, from a simplification standpoint, it may be simpler to deduct all of those costs in cost of goods sold year by year by year and not allocate any of that to ending inventory. So there's the simplification aspect and the actual, really it's a one-time bump in the change. So that example I gave, the 800,000 down to 150, that was a $650,000 swing in taxable income for that client. That swing won't happen every year, because going forward, that client probably is going to carry 100 and something in their inventory every year. So I want to caution about that. It's not like you're going to see a $500,000 benefit year after year after year. There's an adjustment and then a simplified process going forward.
Great points. Yeah, well, 471C again continues to be a hot topic. We're certainly here to answer any questions. We'll give you some information later on how to reach us, but certainly something you should be bringing up with your respective advisors as well, if they're not actively, discussing the subject matter with you all. So definitely something to bring up in year-end tax planning conversations. What else do we have here to share with our audience?
We have time for questions. That's what we have.
Excellent.
Awesome. So I know we answered a few of the questions kind of throughout the webinar, but we did have one specifically asking whether testing laboratories qualify for the PPP from the conversation from the beginning.
That's a great question. I think that, the news is still out as to whether a lab is considered plant touching in that respect. We've not been issued official guidance from the IRS, and it's not been, we've not seen it show up on any tax cases or tax law that would tell us one way or another. So I think that that one's still the $1 million question. We're still out on labs, just because we don't know what position per se the IRS is going to take on that. I'd advise that that lab operator just have an open conversation with their banking institution and see, if they would qualify through them. Ruth, I don't know if you wanted to add anything to that.
That was exactly what I was thinking, is it's really that candid conversation with the bank, because the banks have a lot of discretion in how these funds are distributed and administered. And it's almost like the bank account itself, whether the bank is aware of the specific type of lab they're dealing with, or if they're just taking it as a lab, a testing lab, then just like your bank account, you probably would get approved. There may be more scrutiny looking for forgiveness.
I believe we just had a follow-up question on that same in terms of qualifying for PPPs. Any tips for delivery services?
Delivery service, I think, is part of the plant touching group. They are certainly relevant in the supply chain in respect of getting product to the end consumer. So it goes back to what Ruth touched on earlier, the definition of trafficking. They would certainly meet that profile of a trafficker. And so according to the standards right now, they wouldn't qualify for PPP.
All right, well, those are the questions that were still outstanding. I don't know if Jessica or Ruth, you have anything else we want to touch on? We have a few more minutes, or if anybody else has any last second questions, definitely feel free to put it in the little Q&A section.
Yeah, Justin, we had talked about some questions. I know that those are floating in your email, but I'm happy to touch on those as well.
Yeah, there were a few others. We just go through them right now. So what's the best
please.
way? So yeah, there were a couple other. What's the best way to set up my business?
Ooh, that's a good question that we get quite often. Ruth, I'll let you start on that one.
Well, let's see. We would need to look at the individual situation as in terms of the type of entity. Okay, so whether it makes sense to operate as a sole proprietor, as a partnership, as a corporation, as an S corporation, there are different tax considerations to each. What it tends to come down to in this industry is isolating liability. And an LLC does a really good job of that. That's a good place to start. But then that LLC has to determine how does it want to be taxed. And an LLC or an LLP has options It can choose to be taxed as a sole proprietorship, as a partnership if there's more than one member, or as a corporation. And if as a corporation, then you have another decision to make as to whether to file an S election. Again, liability. Now we look at one of the major considerations is audit exposure. And in any kind of flow through entity, of course, if as a sole proprietorship, the income and expenses are reported on the individual person's tax return. So if there's an audit, it's the person being audited. If it's a flow, what we call a flow through entity, where it's a partnership or an S corporation that's issuing a K1, the income flows from that entity to the individual. So it still is the individual paying the tax. If that entity is audited, automatically the individual returns will be opened up for audit as well. So when you're talking about audit risk, the most isolated choice for audit purposes is a C corporation. And with going back to something Jessica mentioned, the Tax Cuts and Jobs Act of 2017 changed the tax rate for C corporations and introduced a qualified business income deduction to individuals that really levels the playing field between these different entity choices in terms of the rate of tax that will be assessed. So from a tax savings standpoint, they're very similar now, but the C corporation definitely provides some audit insulation. So that's one aspect of to be considered. The other, as I mentioned before, is just legal liability. And then the third is just overall entity structure. If there's different ownership in different activities, it may make some sense to carve the business up into a couple of different pieces, but that needs to be done really carefully in order not to create extra 280E exposure. That can happen. That can happen inadvertently, and it can be very costly. So definitely something where you want good legal and accounting advice in structuring those businesses.
And maybe another point I'll add to that list is more around strategy. And so while we can make an answer that might fit the profile today, the question that we always ask is, what is your exit strategy, or what is the plan for growth? Where do you see that going? Where is the business going in, next year, in years 3 to 5? Because planning is more of a, futuristic, runway. We want to make sure that the decision that's made today still makes sense in 3 years, or in 5, or is at least aligned to get you there and doesn't trip you up along the way, because we've seen that happen as well, where we're trying to unwind or restructure some entity just follow-ups, I'd say, that were done from day one. So really critical to have those conversations with your advisors pretty early on, and having a good sense of your business strategy in the upcoming years is definitely relevant to answering that question, as best we can for you and your business.
Awesome. Yeah, we have a few more. So besides income tax, what other filings should I be aware of?
You want me to start this one, Jess?
Yeah, please.
Yeah.
I have a few to add here.
Yeah, we always look at all of the filing requirements, all of the compliance requirements for our clients. And so, yes, an annual income tax return. Yes, we look at states. What states are you doing business in? And do you have any filing requirements there for income tax purposes? But beyond that, there's also, there's payroll. Hopefully you're working with a payroll company and paying your staff through payroll. 1099s for people that you might be working with that are not on your payroll. Those are important. 1099s, and of course this year they've changed 1099 so that there are different forms to be filed for individuals providing services versus rents, say, or contractors that you might need to issue a 1099 to your accountant or to your lawyer. You may need to do 1099s for interest that you've paid, or that C corporation that issued dividends. So all of those need to be looked at. And again, it's about protecting the business and keeping you compliant all around, not just in the amount of tax that needs to be paid. Another one that comes to mind is a Form 8300 for cash transactions. Those are very important. Again, the sting can be nasty if those filings are missed. Some we don't see as much in this space, but are really important if they're applicable, are foreign ownership transactions. Anything, we do have some clients with Canadian owners. We've got one with an owner in South America. Those, again, there's a $25,000 per entity per year fine if those filings are missed. So, we ask a lot of questions, we ask for a lot of documents, but there is a reason for it. And it's to protect our clients and to make sure that we haven't missed any of these compliance needs.
Oh, Ruth, you're a mind reader. You stole my thunder on the foreign reporting one, which, again, is not common, but is becoming a lot more common, I'd say. In the last, I'd say, year or two, we've certainly seen a lot more foreign activity or ownership in our industry. And so those are relevant. And I think people are not aware that missing those filings could cost, it could be extremely costly if it's two foreign, let's say, reporting entities that are missed. That's $50,000. And so again, I think these are things that sometimes go overlooked. And then, there's a panic mode a little bit when you get a bill for 25,000 plus penalties and interest. So the Form 8300, absolutely relevant in our industry. So again, if there's cash transactions more than 10,000, please remember to get those filed within 15 days of that transaction. And also remember that there's an annual filing that's due at the end of the year. And then maybe to touch on the 1099, compliance factor, compliance is a good thing. If and when you get that audit letter, it's the first things that are being requested from the IRS. It's show me copies of your tax returns. Show me copies of all of the 1099s that you filed. Show me copies of the 8300s. Show me copies. So we have to provide all of this to the IRS. And when we can't, or when the taxpayer can't produce these things, believe me that it leads to a whole host of other questions now, and some skepticism from their part as to whether or not the taxpayer is doing all of the right things. And so we definitely want all of our clients to have the best outcome in audit and otherwise. And so we encourage all of you to be compliant in these other areas, because it does matter. It certainly does matter at the end when we have an agent on the other side.
Awesome. We had a few more come in. Well, one person's asking if the recording's available. Yes, it will be. Hopefully by tomorrow, but if not, early next week, and we'll be emailing it out to all members. So look out for that. And there's another one. Do you think the CDTFA will allow an extension for the 2021 Q1 excise tax?
Oh, that one's a great question. Again, we've not seen any guidance as of yet. We'll certainly keep you and CCIA and its members updated, Justin, if we get some more information. It's still a little over 30 days away. So who knows is I guess the answer to that, but we'll keep everybody informed as we get some more information.
Perfect. Well, I think we got about just a couple of minutes left. Do you guys have a slide with your contact information? Or,
Yeah.
definitely, if you have any further questions and like to get in contact with them, definitely reach out to Jessica and Ruth over at Indiva. But like to thank everybody for coming. Like I said, look out for this recording and then recordings of other educational webinars that we've been doing over the past couple of months and that we'll be continuing to do. So I definitely encourage you guys to get involved in things like our committees. A lot of our webinars and educational content all comes out of those committees. And they're pretty wide range in terms of, you know, finding a committee that works with your license type, or if you're a risk manager or something like that. We definitely have a lot of good conversations happening monthly in those committee meetings. So if anybody has any questions about that or membership, definitely feel free to reach out to me. It's just my first name, Justin at cacannabisindustry.org. And we'll make sure to get you guys involved. But I'd definitely like to give a warm thank you to Jessica and Ruth for helping us out here. And I'm sure there'll be some more stuff coming down the pipeline here soon. So definitely, you know, keep an eye out and feel free to reach out to them. And thank you everybody for taking the time to be with us today.
Thank you,
Pleasure.
Justin. Thank you, CCIA, and thank you to all of the members that joined us here today. Again, we're happy to be here for any questions. Feel free to reach out to us. You can see our emails here. And thanks again.
All right, everybody, have a good day.